Warren Buffett's secrets to being a successful investor. Many people believe that to invest like Warren Buffett, you have to be a financial genius or have millions in the bank. But what if I told you his real secret is so simple you could start applying it to your savings today? Warren Buffett didn't become a millionaire overnight by cracking complex codes or taking risky stock market bets. The truth is, his secrets are surprisingly simple and designed to do one thing: protect your money while it grows. Stay tuned, because I'm going to reveal the golden rules that anyone, from a small saver to a large company, can use to build wealth safely and steadily. And the first one will surprise you because of how obvious it is. When you hear Warren Buffett, the Oracle of Omaha, you probably think of a fortune almost impossible to imagine. But what truly defines his success isn't a magic formula, but rather a philosophy of brutal clarity. He himself summed it up in two legendary rules. Rule number 1, never lose money. Rule number 2, never forget rule number 1. That mindset, one that focuses first on defense and then on offense, is the foundation of his entire empire. It's not about chasing the hottest stock or trying to predict the whims of the market. It's about common sense, patience, and discipline. And the good news is that these principles aren't just for billionaires. They're universal. Today, we're going to break down the key secrets you can start using to build your financial future, whether you're starting with €100 or $1 million. Buffett's first and perhaps most critical principle is the circle of competence. He explains it simply: you don't have to be an expert in every business. You just have to be able to evaluate the ones within your circle of competence. What does this mean in real life? That you should only put your money into businesses or industries you truly understand. Almost all of us understand how a restaurant or a clothing store works. We understand costs, customers, and competition. But let's be honest, how many of us fully understand the business model of a biotech company or a microchip manufacturer? The most common mistake is getting carried away by emotion and the fear of missing out, the famous FOMO, and investing in something just because it's trendy. Buffett became famous for avoiding tech stocks during the dot-com bubble, not because he thought they had no future, but because he humbly admitted he didn't know how to value them. Years later, however, he became one of Apple's largest shareholders. Why the change? Because by then, he no longer saw Apple as a rare tech company, but as a consumer products company with a killer brand and ultra-loyal customers, something that was squarely within his sphere. The lesson is key. Knowing the limits of your circle is more important than its size. Don't pressure yourself to be an expert in everything. Define which industries you know from your work, your hobbies, or your experience, and stick with them. As Buffett says, the risk comes from not knowing what you're doing. Imagine a castle. What makes it impenetrable isn't just its walls, but the moat that surrounds it. The wider and deeper it is, the safer it is from attack. Buffett uses this same idea for businesses. An economic moat, or competitive advantage, is that unique quality that protects a company from its rivals and allows it to be profitable over the long term. These moats can be of many types. One of the strongest is a powerful brand. Think of Coca-Cola, one of its most famous investments. There are hundreds of colas, and in a blind taste test, many wouldn't even notice the difference. But people don't just buy a liquid. They buy the brand, the story, the feeling that Coca-Cola gives them. That's a moat Pepsi has been trying unsuccessfully to cross for a century. Another pitfall is the network effect. Companies like Visa or American Express become more valuable the more people use them. The more merchants accept Visa, the more useful it is for you to have one, and vice versa. It's a self-reinforcing cycle that creates a barrier that's almost impossible for new entrants to overcome. There are also moats based on low costs, like Geeko, another of his big investments, or on patents, as in the pharmaceutical industry. The key as an investor is not just to find a company that makes money today, but one that has an advantage that allows it to continue making money for decades. As Buffett says, it's much better to buy a wonderful company at a fair price than a fair company at a wonderful price. This is one of Buffett's most famous quotes and is the very essence of value investing. The market is a nervous wreck. Stock prices rise and fall every day for 1,000 reasons, many of them purely emotional. But the real value of a company, what its business is truly worth, is much more stable. The secret is not to confuse the two. Price is the label the market places on a stock today. Value is what that company is truly worth based on its assets, earnings, and future. A smart investor buys when the price is well below the value. Buffett and his mentor Benjamin Graham call this difference the margin of safety. Imagine you want to buy a car that you know is worth 20,000 euros. If they offer it to you for 30,000 euros, you laugh. If it's for 20,000 euros, it's a fair deal. But if one day, during a clearance sale, they sell it for 12,000 euros, that's a bargain. You're buying with a safety margin of 8,000 euros. This margin protects you from two things: your own miscalculations and bad luck. The more unpredictable a company is, the larger the margin of safety you should ask for. It's not about simply buying cheap things, but about buying quality at a bargain price. This discipline is what allows you to follow rule number 1: never lose money. The stock market can be very scary, especially at first. News screams crash, prices plummet, and panic spreads. The natural impulse is to sell to avoid further losses. For Buffett, that's precisely the wrong way to think. He popularized a parable from his mentor, Benjamin Graham. Mr. Market. Imagine you have a business partner, Mr. Market. Every day, he comes and offers to buy your share of the business or sell you his at a different price. The problem is that Mr. Market is manic-depressive. Some days he's euphoric and offers you absurd prices for your shares. Other days he's depressed and wants to sell them to you at a bargain price. A smart investor doesn't ask for advice. He doesn't let his mood affect him. On the contrary, he takes advantage of it. When Mr. Market is happy and prices are sky high, it might be a good time to sell. When he's depressed and offering you excellent businesses at bargain prices, it's your time to buy. The key is to be fearful when others are greedy, and greedy when others are fearful. This contrarian mentality is what allowed Buffett to make his best investments in the worst crises. The market is there to serve you, to give you opportunities. Never let it become your master and tell you what to do. They say Einstein called compound interest the eighth wonder of the world. Well, Warren Buffett made it the foundation of his fortune. His biography is titled The Snowball, a perfect metaphor for how it works. Compound interest is, simply put, earning money not only on your initial investment but also on the profits you've already generated. At first, the effect is almost invisible, but over time, the growth becomes exponential. Think of it this way. If you invest $1,000 with a 10% return, the first year you earn $100. The second year, you're no longer calculating 10% of $1,000, but of $100, so you earn $110. The third year, on one new $210. Over the decades, that little snowball turns into an avalanche. The most incredible thing is that almost 97% of Buffett's current fortune was generated after turning 65. It's not that he became a better investor in his old age. It's that he gave his money more than 80 years for the magic of compound interest to do its work. The lesson for us is twofold. First, start investing as soon as possible, no matter how much. Time is the most valuable ingredient and it cannot be recovered. Second, be patient and don't interrupt the process. Every time you cash in, the snowball starts all over again. True wealth is built by letting time and compound interest work for you. If we had to summarize Buffett's philosophy in one word, it might be patience. In a world obsessed with immediate gratification, Buffett plays a different game. His ideal period for holding a stock is forever. This patience isn't passivity, it's pure discipline. It requires a steely emotional control to avoid being swept away by the daily noise. Buffett says that temperament is more important than intellect. You can be a genius at analyzing companies, But if you panic and sell at the first dip, you'll lose money. Much of success, he believes, lies in doing nothing. Most investors feel the need to constantly buy and sell, paying commissions, and making rash decisions. Buffett, on the other hand, spends most of his time reading and thinking, but rarely acts. He waits calmly, sometimes for years, until the perfect opportunity appears. An incredible company at an exceptional price. Of all his advice, Buffett insists that the best investment you can make isn't in the stock market. The best investment is you. Your ability to earn money throughout your life is your greatest asset. Anything you do to improve your skills, knowledge, or reputation increases the value of that asset. It could be a course to improve public speaking, learning a new skill, earning a certificate, or simply reading nonstop to broaden your mind. Increasing your earning potential gives you more capital to invest. It makes you more valuable and opens more doors. In the end, markets go up and down, economies go through crises, but the skills and knowledge you acquire are yours to keep forever. They're the only asset no one can take away from you, and that will pay dividends for a lifetime. As you've seen, Warren Buffett's secrets aren't strange algorithms or secret formulas. They're timeless principles based on patience, discipline, and, above all, common sense. It's about thinking like a business owner, not a gambler. Start by defining your circle of competence. Look for excellent companies with protective moats. Always differentiate price from value and demand a margin of safety. Use market panic to your advantage, and remember that time is your greatest ally. And, above all, never stop investing in yourself. Building wealth is a marathon, not a sprint. Buffett's rules won't make you rich tomorrow, but they offer a proven and sure path to building lasting prosperity. If this video has helped you, subscribe and hit the bell so you don't miss the next ones. And now, I'd love to hear your thoughts. Which of these 7 secrets do you think is the hardest to apply? Let me know in the comments. I try to read them all.